Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Russell 2000 Index, ticker symbol RUT. And as you can see from the chart, I've left my lines on the price action so you can see, again, how accurate our technical analysis is and how accurate our forecast was for last week's report. And right here where my cursor is, I'll put my magnifying glass right there for you, that was when we made the forecast. That's where the market closed last week. Friday right there, I said the market would move back down to the 20-period moving average. That's exactly what happened. And Monday, Tuesday, on Wednesday, we bottomed out. Thursday, we rallied, and today we continued to bounce off of that 20-period moving average. So you can see again how valuable this is as a tool for forecasting, and not just that, but also for managing risk. Now, what does that mean for next week? Well, if you look down at the bottom of the chart right here, you'll see that the stochastics oscillator is still moving higher. That's telling us that the momentum is continuing on the buy side. And if you look down here, the CCI, although I forecasted that the CCI would pull back last week, it did that. It is now still moving higher, but the CCI is in overbought territory. So we have to be very careful with any new buys coming in for next week, because although I do think the market will rally and break out over the most recent high, I think ultimately what will happen is after we rally just a little bit, we'll start to pull back, and I will extend this line right here to the right, as that will be our target resistance area. So we have to really keep an eye on that, because once the market reaches that level, there's a good chance the buyers will start taking their profits. So that's for the Russell 2000. Now if we look at the SPY, which is the S&P 500 ETF, you'll see again as I zoom in, I left my lines on there, I said we would also pull back to the 20-period moving average and fill this gap. Now look at that right there. On Wednesday, we hit that line precisely. We hit our target right on the mark, and we bounced off of that newly established support level as the gap fill price becomes a support level. And I'm going to direct you to a video that will explain more about how to trade the gaps. So again, what does that mean for next week? Well, you can see obviously there's a resistance high right here from last week's high, and I think that the S&P could actually move up to that level to test resistance, and then ultimately I think we're going to pull back. So that's my forecast for next week on the spiders. Now on the Qs, we're going to see something very similar. The QQQ, that's the Invesco Trust, which represents the tech sector. And just like the S&P 500, we moved right down to fill this gap, which was my support level, gap fill support right there. We bounced off of that level, and you can see again the oscillators are starting to turn up, and the CCI is kind of flattening out. So I think next week for the tech sector, we could also see a test of that resistance high. I'm going to draw that just like that, at which point I think we could start to pull back. That's the forecast for the Qs. Now for the VIX, which is the volatility index inversely related to the S&P, you can see that I said we would rally. We did that. We didn't quite hit the target, but the VIX is showing a bearish sign. Again, for the short term, I think the VIX could drop a bit before rallying, and that again is inversely related. So if the VIX is expected to drop, we're expecting the general markets to rally a little bit, and then once the VIX bounces and starts going higher, we are now expecting the market to pull back. Again, inversely related. So that's a forecast for the VIX. Now the diamonds, we did not hit the target, but we came close to bouncing off that support level right here. And what I'm going to do for the diamonds is just extend this out a bit, and like the rest of the markets, I think we're going to retest this resistance area and then ultimately pull back. We have a lot of attention being drawn to the G20. We're going to have to see what happens with the trade deal between China and the US. I'm not as optimistic as some of the analysts out there. I think that even if China presents a trade deal, I don't think Donald Trump is going to accept it so quickly. So that could be negative for the short term. But ultimately, I do think we're going to reach a deal. So that could add some volatility to the market as well. So that's our forecast for the diamonds. If you'd like to learn more about gap trading and how that works, just go to a Market Guy website, click on the video tab right there, and it will bring you to the video page where if you scroll down just a little bit, you'll see a video off to the right that says Trading the Gap, where I will discuss the 80-20 rule and how gaps trade, and that would most certainly help you with risk management and also creating trading opportunities. So that's it for now. Thank you for joining the Market Guys, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.